In 2020, China ran an experiment in the city of Shenzhen. Residents received digital money issued directly by the People's Bank of China. Not credit, not vouchers, real yuan. But with one unusual condition, it expired. If it wasn't spent within weeks, it disappeared, not reclaimed, not taxed, simply erased. Officials described it as stimulus efficiency, a way to boost spending. What mattered wasn't the explanation. It was the capability, money that could be programmed to vanish. That experiment isn't happening over there. It's the visible end of a track that's been laid for a century, and most developed economies are already on it. There's a pattern in modern economic history that's rarely connected. 4 crises, 4 moments of emergency. Each one justified extraordinary powers. Each one promised those powers were temporary. And each time, when the crisis passed, the powers stayed. 1933, 1934, 1935, 1936. These aren't separate events, they're steps in the same direction. The economist Robert Higgs called this the ratchet effect. Government power expands sharply during crises. When the emergency ends, it contracts, but never fully. A residue remains. Then the next crisis arrives, and the ratchet clicks forward again. Higher baseline, new normal. The mechanism isn't hidden, it's historical. April 5th, 1933. The Great Depression is tearing through the U.S. banking system. Depositors are pulling savings in the only form they trust, gold. The Federal Reserve is losing reserves. President Franklin Roosevelt signs Executive Order 6102. It makes private gold ownership illegal. Americans are given weeks to turn in their coins and bullion at a fixed price, $20.67 per ounce. Refusal carries prison time, and fines worth hundreds of thousands today. The authority comes from the Trading with the Enemy Act. There is no war. One man refuses. Frederick Barber Campbell, Manhattan lawyer, Harvard graduate, member of the Metropolitan Club, had withdrawn 5,000 ounces of gold from the Federal Reserve before the order and placed it at Chase National Bank. When the order takes effect, Campbell asks for his gold back. The bank says no. He sues. The government indicts him for hoarding. The case becomes a test. Can owning money be criminalized? The courts ultimately side with the government. The paperwork is fixed. The authority stands. Campbell loses his gold. Then the revaluation happens. After collecting the nation's gold at $20.67, the government resets the price to $35 an ounce. Overnight, the dollar is devalued by roughly 40%. Savers absorb the loss. The proceeds fund the Exchange Stabilization Fund, an emergency treasury vehicle that still exists today. Gold ownership remains illegal for Americans until 1974. What began as a temporary emergency lasts 41 years. The ratchet clicks. August 1971. The global monetary system rests on Bretton Woods. Foreign governments can exchange dollars for U.S. gold. It's the restraint. Print too much, and gold leaves. By the late 1960s, the U.S. is printing claims it can't honor. Vietnam, Great Society spending, France notices. Then Britain. In August, the U.K. requests $3 billion in gold. Paul Volcker later says it was clear the game was over. Nixon convenes a private meeting at Camp David. Treasury Secretary John Connally argues for cutting the gold link. Fed Chair Arthur Burns warns it will unleash inflation and destroy credibility. Nixon sides with Connally. On August 15th, he goes on television and announces wage controls, import taxes, and the key line, the dollar's convertibility into gold is suspended, temporarily. That suspension has lasted more than half a century. With gold gone, the last physical limit on government spending disappears. The 1970s bring double-digit inflation. Gold explodes in price. The dollar weakens. But the trade-off is accepted. Monetary discipline is replaced by discretion. The ratchet clicks again. September 2008. Lehman collapses. Credit freezes. The system is hours from seizing up. Treasury Secretary Hank Paulson goes to Congress asking for $700 billion to stabilize banks. No conditions, no structural reform, just emergency authority. TARP passes. The Federal Reserve expands its balance sheet from under $1 trillion to over $4 trillion. Mortgage-backed securities are bought at face value. Banks are stabilized. Homeowners are not. Foreclosures surge. Losses are absorbed by the public. Profits remain private. One case captures the structure. In 2009, investors led by Stephen Mnuchin buy IndyMac out of FDIC receivership. The deal includes a loss share agreement. Foreclosures are backstopped by taxpayers. The incentives are clear. Foreclosure becomes more profitable than modification. A 90-year-old woman in Florida underpays insurance by 27 cents. Her home enters foreclosure. This isn't an anomaly. It's a system doing what it was designed to do. The concept is moral hazard. Remove consequences, and risk concentrates upward. Those closest to the money survive. Everyone else absorbs the shock. Mnuchin later becomes Treasury Secretary. The ratchet clicks again, March 2020. A pandemic shuts down the economy. Emergency powers expand overnight. Big box retailers are deemed essential. Small businesses are not. Within 2 months, active small business ownership drops over 20%. Asset prices surge. Billionaire wealth rises sharply. It's described as rescue. Structurally, it's consolidation. At the same time, financial access quietly changes. Regulators begin applying pressure to banks over reputational risk. Accounts tied to certain industries, particularly crypto, are paused or closed. No statute, no vote, just guidance. Banks comply. This is often called Operation Choke Point 2.0, not a formal program. No centralized order, just aligned incentives. Access to banking shifts from utility to privilege. If payment rails can be withdrawn without due process, enforcement no longer requires arrest. It only requires exclusion. Which brings us to the present. Digital payments are incentivized through the tax code. Reporting thresholds expand. Side income becomes fully visible. Cash becomes inconvenient. At the same time, central banks prepare digital currencies. China's digital yuan demonstrates expiration. Europe explores conditional payments. The US builds real-time settlement infrastructure. Each piece is justified independently. Efficiency, fraud reduction, speed. Together, they enable programmable money. Seen in sequence, the pattern is consistent. 1933, the substance is seized. 1971, the anchor is removed. 2008, the risk is socialized. 2020 onward. The transaction itself becomes visible. Each step is introduced as temporary. Each becomes permanent. At this stage, in similar historical cycles, populations don't usually revolt. They adapt. They diversify systems of dependence. They maintain parallel rails while they still exist. They treat access as conditional, not guaranteed. They pay close attention to language, especially words like temporary and emergency. Not because of ideology, because concentration of control creates fragility. One consistent lesson appears across monetary history. Doing nothing wrong does not ensure access. Systems enforce alignment, not innocence. Privacy and secrecy diverge here. Privacy is the ability to transact without observation. Secrecy is concealment of crime. Mature systems collapse the distinction because surveillance is easier than adjudication. This isn't about intent, it's about incentives. Control reduces uncertainty. Uncertainty is expensive. Programmable money makes enforcement automatic. That logic doesn't require malice, only continuity. The Shenzhen experiment didn't introduce something new. It demonstrated a capability already implied by the trajectory. Money that expires, money that can be restricted, money that can be disabled. The infrastructure exists. The precedents exist. The language is familiar. Emergency, temporary, efficiency. The ratchet doesn't reverse, it normalizes. Then it advances again. The only open question is timing, what the next crisis will be, and what powers will be justified when it arrives. History doesn't require belief. It operates mechanically, and it clicks whether people are watching or not.